Welcome to the Explainer. Okay, let's just dive right into it. Today, we are looking at a really fascinating intersection of two massive trends. On one side, we have the explosive, seemingly unstoppable enterprise AI boom, and on the other, the unique and often quite volatile world of SME investing. We're going to break down the upcoming GenXAI Analytics initial public offering. Now, we're doing this purely objectively, serving as your impartial investment brief. We're going to look at the undeniable growth narrative, absolutely, but we'll also forensic test the underlying financial and structural risks that every retail investor really needs to understand before putting any capital on the line.
Here's the roadmap for our explainer today. We'll start with 1, the GenXAI IPO overview. Then 2, the bull case, AI growth. 3, the cash flow paradox. 4, third-party dependency risks. 5, global exposure and currency. And finally, 6, the retail investor verdict.
All right, Section 1, the GenX IPO overview, capitalizing on the AI wave.
Let me tell you, there is incredibly strong early momentum here. Before the public even gets a chance to subscribe, GenXAI has already secured 15 crore rupees from 11 anchor investors. We're talking about funds like Nav Bharat Investment Trust and Ment Focus Growth Fund stepping in at the absolute upper end of the price band. That signals some very significant institutional interest right out of the gate for this Jaipur-based technology provider.
So let's break down the actual mechanics of the offering. GenXAI is aiming to raise roughly 54.66 crore rupees by issuing 47.28 lakh fresh equity shares. Now notice the exchange. It's the NSE Emerge platform, which is specifically for small and medium enterprises, or SMEs. The price band is set between 110 and 116 rupees per share. But pay special attention to that minimum investment figure, 278,400. To put that into perspective, that is a massive commitment for a retail investor, dictated by the lot size of 1,200 shares. The company plans to use this fresh capital injection primarily for new product development, specifically their proprietary AI engines, as well as retiring some debt and funding working capital.
Let's move to Section 2, the bull case, AI growth, focusing on a 125% revenue explosion.
Managing Director Rakesh Agrawal highlights a massive strategic pivot. He says, over the years, we have evolved from a consulting-led organization into a technology-driven analytics and AI solutions provider. You see, GenXAI didn't start as an AI company. They actually evolved from Harbinger Consulting, moving away from a traditional, human capital-heavy consulting model right into the high-margin, highly scalable world of digital transformation. They're actively chasing the shift from service-led revenue to software and technology-led revenue.
And honestly, this strategic pivot aligns perfectly with some truly massive macroeconomic tailwinds. Deloitte's 2026 Tech Trends data shows that 64% of organizations are actively increasing their AI infrastructure investments. Enterprises are literally drowning in unstructured data today, and they desperately need companies like GenXAI to clean it up, govern it, and make it AI ready. The demand for enterprise resource planning and data engineering isn't just growing, it's compounding.
And you can absolutely see that demand showing up on the income statement, a 125% revenue growth compared to the entire previous year, hitting 64.27 crore rupees. Profit is up 103%. But what really stands out is that 51.3% return on capital employed. I mean, on paper, GenXAI is an incredibly efficient, highly profitable operation that is successfully capturing this whole AI boom.
But, the income statement only ever tells half the story. That brings us to Section 3, the cash flow paradox. Profit on paper, where's the cash?
Here is a pretty jarring contrast. On one hand, GenXAI reports this massive 125% top-line revenue growth. But on the other hand, their operational cash flow, the actual cash generated by their day-to-day business activities, is currently negative. Think about that for a second. How can a company be so wildly profitable on paper, yet burn cash in reality?
Well, the answer lies in working capital changes. When a company expands this rapidly, especially in B2B enterprise technology, they often have to hire engineers, build infrastructure, and pay for resources long before the client ever pays the final invoice. They can legally book the revenue when the service is rendered, which shows massive growth, sure, but the actual cash is tied up in accounts receivable or operational costs. For a potential retail shareholder, this is a vital risk to monitor. If growth slows down or clients suddenly delay payments, that negative cash flow can quickly turn into a real liquidity crisis.
Which brings us to Section 4, third-party dependency risks, the ecosystem vulnerability.
The reality is, GenXAI isn't doing all of this alone. Roughly 32%, so nearly a third, of all their revenue is intrinsically tied to implementing and optimizing external third-party platforms. Basically, they are building a large part of their house on someone else's land.
And these are the landlords of that ecosystem. GenXAI acts as an implementation partner for massive global platforms like SAP, Analan, and Snowflake. Now, this is a classic double-edged sword. On the bull side, being a specialist for something like Snowflake, a massive cloud data warehouse, guarantees a steady stream of enterprise clients who need help setting it up. But on the bear side, it creates massive concentration risk. If a platform like Snowflake abruptly cuts them off, poof, a huge chunk of their pipeline just vanishes.
And that leads us to ask a really critical question. What happens if Snowflake decides to bring more implementation services in-house? What if SAP dramatically increases the partnership fees that GenXAI has to pay just to remain in their ecosystem? GenXAI boasts very healthy operational profitability right now, with EBITDA margins around 29.5%. But because a third of their business relies entirely on external corporate decisions over which they have zero control, those margins could be squeezed instantly by a single policy change over in Silicon Valley.
Now let's explore Section 5, Global Exposure and Currency, the hidden costs of global reach.
Currently, 50% of GenXAI's revenue is generated overseas, with a very heavy concentration in the United States. While geographic diversification sounds fantastic in theory, being heavily reliant on a single foreign market introduces some serious geopolitical and macroeconomic variables. If the U.S. enterprise sector experiences a localized downturn, half of GenXAI's entire revenue stream is directly in the firing line.
But perhaps even more subtly, this introduces immense currency fluctuation risk. Let me explain why this matters so much. GenXAI incurs most of its operational costs, like engineer salaries, office space, things like that, in Indian rupees, but half its revenue is paid in US dollars. So if the US dollar weakens against the rupee, the money GenXAI makes in America suddenly translates to fewer rupees back home. Without selling even one less service, their reported profits in India could artificially deflate simply due to the exchange rate. It's this invisible variable that can dramatically impact that whole 125% growth narrative we talked about earlier.
Finally, let's bring it all together in Section 6, the Retail Investor Verdict, weighing the SME market reality.
We have to remember GenXAI is listing on the NSE Emerge platform, designed specifically for SMEs, and this introduces the stark reality of SME liquidity risk. Unlike mainboard stocks like Tata or Reliance, where millions of shares trade every single minute, SME stocks have much lower trading volumes. Coupled with that incredibly high minimum investment of over 2.7 lakh rupees we discussed, it means there are significantly fewer buyers and sellers on any given day. If the market turns volatile, you might find it incredibly difficult to sell your shares without taking a massive price cut. Your capital can easily become trapped.
So let's look at the ultimate impartial summary here. The bull case is undeniable. GenXAI is positioned squarely in front of a massive, high-margin AI sector tailwind. They boast an incredible 51.3% return on capital employed and have strong initial backing from institutional anchor investors. But the bear case is equally grounded in reality. They are fighting negative operational cash flows, they're heavily dependent on U.S. currency stability and third-party tech giants like Snowflake, and they're subject to the volatile liquidity traps inherent to the SME exchange itself.
Which brings us to our final thought. The numbers on the income statement are absolutely spectacular, but the foundational mechanics require a pretty high tolerance for risk. As a retail investor, looking objectively at the cash flow paradox and the structural dependencies we've covered today, is the AI growth story worth the SME liquidity risk? That is the question you must answer for yourself. Thank you so much for joining us for this explainer. Until next time, keep learning and stay